Alright, welcome back to another video on the After Hours channel. In this video, we're going to be discussing a recent buy that I just made. I invested an additional $1,600 into one of my holdings, and I'll be letting you guys know exactly which company that is. And because I'm buying into this company, I obviously still think it is a buy right now, and I still think it's undervalued. But before we get into that, one of the most asked questions in investing is how do you determine a great company? And when I say great, I am distinguishing great from good. There are good companies out there that can make a decent investment, but I am not in the market of investing in good companies. I'm buying great companies. Good companies make for average returns. I'm looking for outsized returns. I'm looking for companies like this one, Visa, where their free cash flow year after year continuously goes up, and in the last 10 years increased by over 22%. Now this is a great company. Now a growing free cash flow is not the only indication of a great company. We take a look at their net income and we see the same exact thing, huge growth over the last 10 years. What other characteristics define a great company? Well, we'll use Microsoft as an example real quick. We're looking for companies with an entrenched moat. What does that mean exactly? They are the industry leaders in their position. Their company is so entrenched within the market, it is extremely hard to disrupt them. They have such a foothold on the audience and the customer base that they have that it's virtually impossible to knock this business off their throne. And not only that, we're looking at balance sheets around here. Companies with over $100 billion in cash. Now that is a well-run business, and that is a great business. Now what is another characteristic of a great company? Not diluting their shareholders, buying back their own stock. But don't take my word for it. Let's take a look at an old interview by Peter Lynch, who is arguably one of the best investors of all time, and see what he has to say about great companies and investments in general. How do we find an investment that's going to go up over time and compound?
Didn't do any research, they bought a piece of junk, they didn't look at the balance sheet, and that's what you get for it. And that's what we're being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated.
There is a company behind every stock. That is really something that I think investors nowadays need to hear. You are not just buying into a stock picture, you are buying into a company. That company has a balance sheet. Do the extra step of doing some research, take a look at that balance sheet and see, is this a great company? Too often nowadays, we do more research on items we're going to purchase than the companies we invest tens of thousands of dollars into. Now let that sink in and really think about it for a second. You'll take the time to look at all the specs of a new car you're going to purchase for a week, but yet when you want to put $10,000 in a new stock that you heard from somebody else, you take their word for it and you don't even look at the balance sheet. That is not what we're going to be doing in 2024. And for those investors out there that are fearful of losing their money, let's see what Peter has to say about that as well. I really think it's going to open your eyes.
About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. If you understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it, 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times.
So as long as you understand that the market is going to go down when you're invested, you'll be much better off. It is a natural fluctuation in the market that shouldn't scare you out of it. As long as you know you own a great company and you've done the research for yourself and you took a look at that balance sheet, don't let yourself become fearful when that price drops. Look at it as an opportunity and a discount to buy more shares. One new holding in my portfolio, I believe, embodies all of those characteristics. They've excelled in their industry, they have a major foothold in it, they have an economic moat, they have an ironclad balance sheet, and they've strategically managed their balance sheets and their financials to withstand any recessions or economic downturns. That company I'm referring to is none other than United Health Group. When we look at this company's balance sheet, it is incredible. The fact that more people aren't buying into this is beside me. With free cash flows increasing by nearly 15% 10-year average, and their free cash flow per share exceeding that. If somebody asked me to illustrate the revenue of my preferred company, it would look something like this. Healthy growth year after year. But when we look at the performance of this stock over the last year, we see the exact opposite. Only up 8%. And when I was buying into this company, it was relatively flat. It only recently had that run up. So when you have companies like Microsoft and Apple going up nearly 50% for the year, and then you compare United Health to their balance sheets, you have to ask yourself the question, why isn't this company racing up as well? And is there potential value in this company that others aren't pricing in just yet? In my eyes, yes, that is exactly what I think. We take a look at their net income, same thing, year after year with explosive growth. 1 month ago, I did a full video breaking down this entire stock when I made a $5,000 purchase into it. And 1 month later, I feel the exact same way. This company, in my opinion, is undervalued, and that is why I'm still buying in. Taking a look at my recent purchases, you can see today I actually just purchased another $1,000 of this company. That $1,000 comes at a price point of $538 per share, which is just $2 under my average cost. Not long ago on January 6th, I made another $642 purchase at $539 per share. December 12th, I bought an additional $208 of this company, and on that same day, I invested a $20 dividend I received right back into it. So as I high grade this portfolio that you see on your screen right here, I am doing my absolute best to identify compounders, industry leading companies that are extremely hard to disrupt, have ironclad financial sheets, and have an easy business to understand that is not easily affected by market downturns. Another company that highlights some of these same qualities is none other than Visa. I have over $10,000 invested in this company alone, and it makes up over 11% of my total portfolio. Not only do I enjoy the growth of the stock price, but we look at the financials and the shareholders enjoy the rewards from this as well. We look at this company and how much they made in free cash flow, and we compare that to how much they paid their employees in stock-based compensation, and it's barely a fraction. Further illustrating the fact that this is one of those companies that does not purposely dilute their shareholders. We look at the dividend growth of this company over time, and it is just incredible. One of the largest dividend growers in my portfolio, increasing their dividend over the last 10 years by nearly 18%. And as far as returns on capital employed, all of the companies in my portfolio continuously keep that percentage above market averages. And when we're comparing great companies to good companies, another thing I want to point out is when you buy into a great company, you'll know because they are constantly increasing shareholders' value while you sleep. So not only are they increasing their revenue each year, their free cash flow, the stock price is going up, but they're making an effort to buy back their own shares, which artificially increases your value as a shareholder. Less shares in the market means your shares are worth more. So going forward for 2024, I'm not changing much about this portfolio and my overall investing strategy. If anything, I'm leaning into my convictions even more by attempting to identify the market leading companies that are at a slight discount. Companies like Microsoft, like Apple, like Vici Properties, with some of the best real estate on the Las Vegas Strip, with Visa's payment processing, and with United Health's foothold in the healthcare market and their pharmaceutical company. So when you continue to invest this year, remember to ask yourself, is this a good company or a great company? 100 investments of good companies could not make up for the returns you're going to get from a great company. Stop wasting your time with the losers and take the time to invest in yourself and the companies that you're going to be putting money into. Every day we go out there and purchase things that we really don't need, and we don't think twice when we spend a couple $100s on a new phone or new laptop, a new computer. But the moment we hear from a friend or a coworker that they're making money in this speculative company or this hype stock, we buy in because the fear of missing out. You don't want to be the only one left not making money. But I can assure you, if you reconfigure your investing strategy and truly put an emphasis on high quality compounding companies, you can't go wrong. So going forward, I'm going to do just that. And I'm going to be taking you guys on the ride with me. Full transparency going into the new year, regardless of the ups and downs. So to make sure you don't miss a video in the future, don't forget to like, subscribe if you got anything out of this. And if you would like, I have a Patreon you can check out. Gives you access to a full investing community and exclusive content that nobody else sees on YouTube. I wish you guys the best of luck going forward with your investments, and I hope to see you in the next video. Take care.